The market's sending mixed signals, a total mess. Our job is to cut through that noise, find the real, data-driven signal, and build a solid trading thesis for Q4. Let's get right to it.
Right now, the tape is just a war between bullish and bearish headlines. It can be pretty confusing. So what we're going to do is separate the sentiment from the substance. We're going to use hard data to figure out which story is actually most likely to win out.
And here it is, the core conflict in a nutshell. You've got a major player like General Motors absolutely crushing it. I mean, that's a classic risk-on signal. But at the very same time, you see the safe havens, the gold miners, just getting hammered. So which is it, risk on or risk off? Let's dig into the bull case first.
Okay, let's be clear. The bull case here isn't just some hopeful fantasy. No, it's built on some pretty powerful stuff, a combination of historical trends and, more importantly, structural liquidity flows. This creates a potential tailwind heading into the end of the year. So first, let's just look at the historical data. If you go all the way back to 1928, the S&P 500 has, on average, gained about 4% from late October to the end of the year. Now look, history isn't a guarantee, but that is a really powerful seasonal trend you just can't ignore.
And if you think that's something, check out tech. The data for the NASDAQ is even stronger. We're talking an average gain of 8% in that same Q4 window. This isn't random noise. It's a clear seasonal tilt towards risk assets. And that's where the big moves happen.
Okay, so that's history. What about right now? Let's talk money flow. A staggering $28 billion just flooded into global stock funds in a single week. That's the big money, the institutional capital finally getting off the sidelines. That is real demand, and that's the kind of fuel a rally needs.
And this right here, this liquidity timeline is absolutely crucial. See that selling pressure we typically get from mutual funds in October? That's starting to fade. But the big date to watch is October 24th. That's when the floodgates open. You've got about 40% of companies coming out of their buyback blackouts. We're talking about the single biggest buyer of U.S. stocks stepping back into the market, right as we head into November, which is already a historically strong month. This isn't a guess, it's a structural setup.
All right, that all sounds pretty good, but let's not get ahead of ourselves. A solid thesis always has a reality check. We have to define the risks, the things that could completely blow this bullish idea out of the water. And there are some very real macro threats out there that we need to be watching like a hawk.
And to be clear, this is not about trying to predict a crash. That's a fool's game. This is about being prepared. It's about knowing exactly what would need to happen, what data point, what event that would make us tear up the bullish playbook and immediately shift our stance.
So I'm tracking 4 key headwinds. First, any kind of geopolitical shock. If Russia rejects a ceasefire, you could easily see new sanctions and a nasty spike in energy prices. Second is margin compression. Look at a company like Elevance Health. Revenue is up, but their profit got cut in half. If that becomes a theme this earnings season, the market is going to reprice everything lower fast. Which leads to the third risk, weak guidance. And finally, you've always got that lingering threat of a U.S. government shutdown, which just throws a wrench of uncertainty into the whole mix.
Okay, so let's take these big macro risks and see how they're actually showing up in specific sectors. Because this is where the rubber meets the road, right? This is where you can really see that tension between the bull and bear case playing out in real time.
And this table really lays it all out. You've got this huge divergence. On one hand, you have the auto sector, led by GM, which is just on fire. You want to watch the follow-through buying volume there. But then you look at healthcare, and you see companies like ELV signaling serious margin problems. I mean, a 91.3% benefit expense ratio, that's a huge red flag. Meanwhile, gold miners are flashing risk off, so keep a close eye on gold futures. And energy? Well, energy's a tinderbox, and crude oil's the match. This is a market where you have to be incredibly selective.
This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
Okay, so we've got the bull case and we've got the bear risks. Now let's synthesize all of this. It's time to put it together into a practical framework, something we can actually use for positioning with clear scenarios and actionable setups.
So here's a simple, disciplined, 3-step process for navigating this. Step 1, you monitor the triggers. We're talking energy prices for any geopolitical spikes and earnings guidance for signs of margin weakness. Step 2, you wait for confirmation. Be patient. See how the market reacts after that October 24th buyback window opens. Don't front-run it. In step 3, you execute your plan based on the scenario that's unfolding with your risk already defined.
Okay, strategy 1. Let's say the bull case plays out. The idea here is to ride that broad market seasonal tailwind. You could look at a bull call debit spread on SPY or QQQ with a November-December time horizon. The rationale is simple. It lets you capitalize on an expected rally with defined risk, and it's a hell of a lot cheaper than buying calls outright. And your exit plan is just as clear. A sharp spike in the VIX or a break of key technical support, and the thesis is invalid. You're out.
Now, for a more sector-specific idea, let's go back to that margin compression story in healthcare. The thesis for ELV is a long-term recovery play, so this is not a quick flip. We're talking a 1 to 2 year time horizon. You could structure this a couple of ways. Maybe selling cash-secured puts down near that $300 level, a level where management itself has been buying back stock. Or you could use a LEAPS call spread dated way out to late 2026 to align with their recovery timeline. And the exit? If management backs off their long-term growth targets, the thesis is broken.
And finally, let's talk about a strategy to play one of the primary bear risks, or to hedge against it. That's the energy volatility thesis. You could use a call debit spread on XLE with a 1 to 3 month horizon. This is a direct, risk-defined bet that U.S. energy producers will benefit from geopolitical volatility. But you have to remember, this is a pure catalyst trade. The moment you see a real de-escalation in geopolitical tensions, that catalyst is gone, the thesis is invalidated, and you exit.
Not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data.